Hello everyone, welcome to Demand Supply Trading Practical session number 37 for the year 2024. Myself, Sujit Kakkar, and today is Sunday, 29th of September 2024. And before we move ahead, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, we have started with the WhatsApp channel where we keep updating you regarding the schedule of these sessions. Plus, if we have any upcoming videos or if you have any upcoming promotions, that is where we update you. So, in case you want to join the channel, you can scan the QR code, which is available on the screen. Otherwise, the direct link is available in the description. You can also click on that link and you can join this channel. All right, so today's session is practical application of demand supply methodology. Our demand supply course used to be a paid course, but sometime back we made it as an absolutely free course. So if you want to learn the complete methodology, you can go through the course content. The links are available in the description. Course is available in two languages, English as well as in Hindi. And going through the course will basically cover the complete methodology theoretically. Now, once you have learned the methodology theoretically, unless and until you go through some practical sessions, it's not very easy to understand how it has to be applied. And that is what we do in these sessions. In these sessions, I take some examples, and to those examples, we apply the complete methodology very mechanically, very rule based, and that helps you in understanding how to plan trades in a very mechanical and rule based way. Now, the beauty here is that when I do the analysis for you, we are doing the analysis in advance. So we are not looking at something which has already happened, because something which has already happened, it's very easy. You can apply a number of indicators, a number of oscillators, and you can find a number of reasons and join the dots and say, okay, this is why we would have bought, or this is why we would have not entered this trade. But the way I do it is we are doing the analysis in advance, which means we don't know what is going to happen in the future. So we are not looking at a trade which has already played out. We are planning a trade for the future. And just because we are doing the analysis in advance does not mean that I share these analysis with you and then we forget about it. Whatever analysis I share with you, whenever they get triggered in the future, we also review them, and that helps you see both the before and the after. And once you have gone through quite a few examples, you will start seeing how beautifully the methodology works, and that helps you build your confidence into this methodology, because only once you have a confidence in a methodology, you'll be more inclined towards learning it and practicing it, right? So that is how I go about. I do the analysis in advance, and we also review them once they get triggered. So we are not looking into something which is already played out, which else is a piece of cake. You can pick any indicator, any oscillator, you can apply that, and you can have a number of reasons why you would have participated in it. Anyways, so before we start with the analysis for today, we do have a trade example which was getting carried forward for us. So we'll start with the review of it. uh, Once we are done with the review of it, then we'll start with our example for today. And today's example is also a very interesting example, because we are at session number 37. So this is the very first time we are picking such an example for session number 37. The example is for a symbol which is making all-time lows, right? So if a symbol is making all-time lows, yes, you will have supply areas available to you, but you might not have demand areas for your curve analysis. Plus, when is the time when a symbol is making all-time lows, that okay, now is the time probably I can start looking for some long opportunities. How do we add those factors into our trade plan? We'll also look into that. All right, so let's get started with the example which was getting carried forward for us before we continue with our analysis for today. So this is the one which was getting carried forward for us, and we did the analysis for this on the 15th of September. This was our session number 35, and the prices came into the zone on the 19th of September. So the last time we reviewed it, we talked about that as a type 2 trader, yes, you would have got your opportunity to participate. But if you wanted to do a type 3 trade, you can see on this particular candle, you could have also got your opportunity to do a type 3 trade. Now prices did come pretty close to our 1:1, but it has not yet hit the 1:1 mark where you could have made the trade as a break-even trade. But yes, if you did a type 2 trade where your entry could have been a little deeper, then your risk would have been smaller, and in that case probably you would have also got a move which is more than 1:1, and you could have made the trade as a break-even trade. So yes, depending upon what kind of entry you took, whether it was a type 2 entry or whether it was a type 3 entry, the zone would differ a little bit, because having a deeper entry means a smaller zone, and a smaller zone means the move which you have already got would have been more than 1:1, where at least the trade could have been converted into a type 1 trade, sorry, a break even trade. But as of now, we will go with our original proximal line and the original distal line. And based on that, we have not yet got the opportunity to make it as a break even trade. So we will still keep it as an open trade. We'll track it for the next few weeks and see how this one progresses. All right, so that takes care of the only example which was getting carried forward for us and got triggered. If we don't have anything else pending, so we can start with our analysis for today's session. So just give me a minute. Let me bring up the chart, and also let me bring up the documents. Perfect. So whenever I talk about trading, always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video, and the title of that video is How to Start Trading. Now, during the session, if I'm talking about some documents, if I'm talking about some videos, all the links are available in the description. So not to worry, where do I find them? Just go into the description, read through the description, you'll find all the relevant links. So yes, like I said, trading has to be mechanical, trading has to be rule based, and the video will help you understand why it needs to be that way. And there is a process that I've explained in that video, and you will have to go through that process probably once, maybe twice, maybe even thrice. But the more number of time you go through that process, you will start seeing that eventually you'll be a more rule-based trader versus a trader who's making the trading decisions based on the emotions. Now, to be a rule-based trader, we need to create something which is called as a trade plan. And when you're started when you've just started learning trading, or you've started learning a new methodology, it's not very easy to create a trade plan from day one, because you need quite a good experience of that methodology before you can convert it into a step-by-step process. And to overcome this challenge, I have created a trade plan for you, and this trade plan is basically a combination of two documents. The first one is your trade plan steps, which guides you what you need to do as a demand and supply trader step by step. You can also call it as the flow chart or the walkthrough, and every step has its own elaborate rules, which you can find in the rule book, right? So this rule book is a conservative approach. With time, with experience, yes, you can modify it based on your preference, but at least you do have a starting point using which you can start planning your trades, and eventually you can work on it. So what is our step number one whenever we start planning our trade? Our step one is to define our trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies my expected duration of the trade, and the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit here, the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why are we starting with the trade purpose as our step number one? And the reason is, whenever we do our analysis, we use charts which are time-based charts, and we have a number of time frames available to us. So since we have so many time frames available to us, the very first challenge we face is that out of these a number of time frames, which time frame should I be using for my analysis? And now if your methodology is based on multiple time frame analysis, you don't have to select one time frame, you have to select multiple time frames. And what analysis I should be doing on each and every time frame, that's another challenge in itself. So to overcome this challenge, what I've done is I have given you some predefined trade purposes and predefined time frames which we'll be using for those purposes. So let's understand what these different trade purposes are. So I have divided these trades into four different purposes, and we call them as hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income is a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks, and monthly income is a trade which can last for a month or few months. Now, by definition, I definitely say daily income is a trade which can last for a day or few days, but if you're trading markets which are not 24-hour markets, then I'm pretty sure you would have experienced whenever the market opens, some symbols they gap up, some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting. But if you get a gap against you, you can also lose more than what you were willing to lose on that particular trade. So we understand that whenever we keep a position overnight, by keeping the position overnight, we are taking that inherited gap risk, which cannot be avoided. And what we do is, as a risk management rule, initially to avoid that unnecessary gap risk, we will do hourly incomes and daily incomes strictly as intraday trades, will not keep them as overnight trades. Now when we are talking about weeklies and monthlies, anyhow we are not expecting to get the exit the same day, so here we have no choice, we will have to keep these positions as overnight positions. But that does not mean that we cannot have a gap against us for weekly monthlies. It can still happen, but since we are leaning against some bigger time frames, the probability definitely reduces. Plus, when you're doing your weekly income, monthly incomes, you're also using bigger time frames, so the zones are also a little wider, which can absorb even if you get a gap against you. Prices might not gap beyond the zone, they might gap a little deeper into the zone. But yes, you still have that possibility that you might have a gap against you, but a little less. So again, initially hourly dailies will be strictly intraday trades, weekly monthly is overnight. But with time, with experience, if you want to include a daily income into overnight trades, that can be done, because like I already said, daily income means a trade which can last for a day or few days. So let's assume I opted, I want to plan monthly income trades. Now once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if I go to page number 28, we start with the topic which is multiple time frame analysis, because demand supply is not based on a single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis, intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits, and the refining time frame can be used for multiple purposes like fine tuning the zone, different kind of entries like your type 2 type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question is that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Like in this example, I opted, I want to plan monthly income trades. So now I know as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly will be the higher time frame, which is used for curve analysis. Weekly will be the intermediate, used for trend analysis. Lower time frame is daily. That is where we get our SCTS from. SCTS stands for stop loss, entry, target, and size. And in case I need to use the refining time frame, then my refining time frame will be the 60 minute chart, which can be used for multiple purposes like fine tuning the zone, type 2 type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4? In fact, I should also add, now this table that I've given you on page number 31, this is specifically for the Indian NSE market, because this market is only open for 6 hours and 15 minutes. If you are trading markets which are open for longer durations like your commodities, forex, or if you're doing cryptos, then you can look into this table which is on page number 32. So as soon as I am done with my step number 1, I select my purpose of trade, I get the clarity to what time frames I am using, plus what analysis I'm doing on each and every time frame. I have clarity to it. So my challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames, but on the NSE exchange we have about 2000 plus companies listed. So humanly not possible that I sit and analyze 2000 companies every day. So our next step is to have a smaller list from this bigger list, and that is what we do. We select some scripts, and the way we do this is by using certain computer programs which are called as scanners or screeners. And the way these computer programs, they basically work is we input certain conditions into them, that these are the conditions I'm looking for, and then these computer programs identify that out of these 2000 plus symbols, which symbols are matching with those conditions. Whatever is matching with those conditions, it gets shortlisted for us, and that is how we get a smaller list. Now very important, irrespective what scanner or screener you're using, whatever results you get, you can never blindly buy or sell those symbols, because the scanner never tells you what you need to buy or sell. The job of the scanner is just to give you a smaller list out of a bigger list. Once you have that small list, you will have to manually analyze each and every one of them and check which one matches with your trade plan. The one that will be an exact replica of your trade plan, that's an opportunity for you. The one which does not match with your trade plan, you simply skip it. Now, a few examples of these scanner screeners. Example 1, if you go to my website under the free tab, you will see I have created some scanners for you, and these scanners are based on some moving averages. They'll help you shortlist some symbols. Second example, if you search on my YouTube channel scanner, you'll be able to find a few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You'll also be able to find a video on top-down analysis, which can help you in shortlisting symbols. So these are three, four different examples of scanner screeners which can help you in shortlisting symbols. But you're not restricted only to these three, four. Let's look at few examples before we move ahead. So like I said, once you go to our website, under the free tab, you have stock screener. Because I want to plan the MIT trades, I can run the long scan and the short scan. So here you can see the long scan is shortlisting about 8 symbols for me, and the short scan is not shortlisting anything for me. Now, like I already said, very important, just because I got these 8 symbols as a long scan does not mean I'll blindly buy these 8. Similarly, if I would have got some results from the short scan, does not mean I would have blindly sold those symbols. So remember, the job of the scanner was, I can't analyze 2000 plus companies every day. It gave me a list of 8 symbols. I'll analyze these 8. Out of these 8, if anything matches with my trade plan, I have an opportunity. If nothing matches with my trade plan, I don't have any opportunity. Now, many times what can happen is your list can be a very small list, like you can see today, or maybe nothing is matching with these conditions and nothing is getting shortlisted. Now, obviously, if you have a bigger list, the possibility of finding something which is in sync with your trade plan increases. So if you want that you should get a little bigger list, then you can, play with these conditions. Now, example, you can see here I've given 5 different conditions. Just disable the third one, run the scan again, and I'll do exactly the same thing here. Disable the third one, run the scan again. So initially you saw it was giving me about 8 symbols for the long scan, but after making that modification, now you can see I have 108. And if I go to the short scan, which was not shortlisting anything, is now giving me around 19. So in totality, I have 127 symbols to look into. So yes, it's not a very big list. It's not that out of 2000, you're getting a list of 500, 600 symbols. It's just about 127, which can be easily analyzed, I'll say, in about half an hour, 45 minutes. Now, if you feel the list is still big, you further want to filter it out, you can use different filters. Simple example, I can say, okay, I don't want from the cash segment, I only want the ones which gets traded in futures. I'll run the scan, and you can see from 108 now I'm down to just 19 symbols. So yes, you can use different filters. You can use different scanner screeners. Example, if I go to the screener section on this website, you can see you have over 150,000 scanners available to you. Some of them are based on fundamental analysis. Then you have your top left. Then you have based on candlestick patterns. Then you have your range breakouts. You have your bullish scan. You have your bearish scan. Then you have your intraday bearish, intraday bullish crossovers. So a number of scanner screeners available to you. All of these will give you different results. Whatever you feel is the best fit for you, you can use that and you can get your list. So again, going back to our flow chart, step number 2 was to get a smaller list out of a bigger list. In this example, we got about 127 symbols to look into. Now, once you start analyzing them, there are again few challenges which you will eventually realize. So let's talk about those challenges and what could be the possible solution for those challenges. So challenge number 1, what you'll realize is that when you're going through this list, majority of the symbols, they don't have any quality demand areas or supply areas using which you can plan your trades. And the fact is, to plan our trades, we do require quality areas. If we don't have zones, there are no opportunities available to us. And the reason for that is because all these 150,000 plus scanners, screeners I showed you, they are all based on either conventional technical analysis or fundamental analysis. And that is why if something is getting shortlisted, does not guarantee that you'll have a quality zone on it. And let's assume that if some of these symbols, they do have some quality zones. In fact, we'll come to that point later. Again, coming back to this one, since majority of them will not have quality demand areas or supply areas, you will be wasting a lot of time analyzing such symbols where no opportunity is available to you, right? So it will be a lot of time wastage. Now, some of the symbols which might have some quality demand areas or supply areas, those zones might be far away from the current market price, due to which what will happen is you'll have a longer waiting period before the prices are back into your zone. And during that waiting period, whatever price action develops, it might even disqualify the trade setup for you by the time it is back into your zone. So these are two challenges which you face when your scanners are not based on demand supply areas. They are either based on conventional technical analysis or fundamental analysis. And what is the solution to it? We have created two custom built tools. One is called as the alert service. The other one is called as the screener. Now, if you want to understand them more in depth, the link to the walkthrough videos are available in the description. But few things which I'll definitely add here. One, These are not call giving or tip giving services. These are scanner screeners, which are purely based on demand supply zones. And how do they work? I'll just quickly show you. But like I said, I'll just quickly go through them. For more in-depth information, you can just go through the walkthrough videos. So how does the alert basically works? Alerts are based on the demand and supply zones which are getting formed during the live market. Now we do have the demo channels for our alert service, and we have demo channel for NSE, we have demo channel for MCX, we have demo channel for Forex. So here I'm showing you example of the NAC channel for the 27th of September, which was Friday. And you can see we give you alerts for half an hour during the day, which is from 11:15 to 11:45 Indian Standard Time. So you can see that at 11:15 we got an alert that on a particular symbol we have a rally based drop on the daily time frame. This is the proximal value, this is the distal value, and you can see these alerts are getting updated as and when during the live market zones are getting formed. So you can see this is for the daily time frame. You have for your 15 minutes time frame, for the 5 minutes time frame, for the 5 minutes time frame, and this alert was at 11:15, at 11:20, then you can see at 11:25. So as and when these demand and supply zones are getting formed, you keep getting these notifications on which symbol, on which time frame the zone has formed. And again, very important, just because you know a demand or a supply zone has formed does not mean you can blindly trade them. These are not calls or tips that you can buy at this demand area or you can sell at the supply area. The scanner is just telling you where these zones are getting formed. You will have to now qualify these zones based on your trade plan. Only if they qualify based on your trade plan, they can be your opportunity. So again, during the live market, as and when the zones they get formed, you get these notifications, and that is how the alerts they basically work. And how does the screener work? So just to show you example of screener, here you can see I have applied screener to a chart, and I've given a list of about 40 symbols, and then I've given a condition that my proximity should be 1%, right? So proximity percent should be 1. So what do I mean by that? That when my current candle is within 1% to a demand area or a supply area, shortlist that for me. So can you see it is telling me these are the only symbols out of those 40 symbols which are within 1% proximity to a demand area, and these are the two symbols which are within 1% proximity or less to a supply area. So as an example, if I go to the first one, which is Bajaj Auto, so here you can see we'll have a demand area and my current candle will be pretty close to it, and that is what you can see. We have a demand zone, my current candle is close to it, and that is how the screener basically works. And it can be applied to different time frames. Example, currently I'm on the daily time frame, so it is giving me results based on the daily. If I change it to weekly, now it will start giving me results based on the weekly time frame. So yes, you can create this scanner for you for different symbols, and now if you want different time frames, you just need to change the time frame and you'll get the results for it. All right, so that's your example of two scanners which are purely based on demand supply zones. Both of them have different approach. Alerts are purely based on the zones which are getting formed on that particular day during the live market, and screener is your proximity to the zone, whether that zone was formed on the current day or a day before or a week before or a year ago or 10 years ago. Doesn't make any difference. As long as we are in that proximity range, it will get shortlisted for you, right? So second step was to get a smaller list. I showed you a number of options that are available to you. Out of this, whatever you feel is the best fit for you, use that, get your list. Process can be as simple as I don't want to use any of these scanner screeners. I will only analyze, let's say, my Nifty 50 stocks, or maybe I have my own favorite list of symbols which I want to analyze every day. So choice is yours how you want to get that small list. I have given you few tools. Many of them are free, many of them are subscription based. Whatever you feel is the best fit for you, use that, get your list. Now, once you have your list, you already know your time frames from your step number 1. In this case, it was monthly, weekly, daily, and 60. Now, I also know what symbols I'll be analyzing. So now you need to analyze them one by one. Out of this, whatever matches with your trade plan is your opportunity. Whatever doesn't match with your trade plan, you simply skip it. So let's assume the very first one was ABC. So what am I supposed to do on ABC? I need to go to the lower time frame. So the question is, what is my lower time frame? We got the answer from our step number 1. That is a monthly income trader. My lower time frame is daily. So here lower time frame would imply the daily time frame. And on that time frame, we need to identify zone. And by zone, we mean any of these 4 structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. So let's go to our charts, and here you can see I have applied the demand and supply zone indicator. So what the demand supply zone indicator basically does is that I don't have to identify the zones now. It automatically identifies the zones for us and also plots these zones for us. And mind it, the demand supply zone indicator is not based on boring exciting technique. It is purely based on price action, and that is what is demand supply methodology is all about. So always say demand supply is a price action based methodology. Now, what do we mean by price action? Price action simply implies the action done by the price. And what action can price do? Only two things. It can either move up or move down, cannot do anything else. But when price is moving in a narrow range, we call it as a period of pause, or you can also call it as your base. Now, initially, when our eyes are not trained to identify these structures, to start training our eyes, we start with a concept which is called as boring exciting technique, because you will see majority of the zones can be identified based on boring exciting technique. Again, I'm saying majority of the zones. I'm not saying all of the zones. But as and when your eyes they get trained to identify these structures, then from boring exciting you'll start shifting towards price action, which is understanding the flow of the price and seeing where that period of pause was. Now, when we talk about boring exciting technique, I have created a boring candle indicator and an explosive move indicator. Both these indicators are absolutely free indicators. You can use them for free forever. When it comes to the demand and supply zone indicator, we do have a demo version available. So if you go to the indicators on the trading view and search for demo demand supply zone indicator, you'll be able to find the demo version. You can use it. The limitation of the demo version is that it will only be working on the daily time frame. You cannot use it on any other time frame. And yes, you can even use that indicator to keep training your eyes how these structures they look like. And eventually, if you feel that you need the indicator, you can go for the full version. If you feel you just want to do it based on you're eyeballing these areas of demand and supply, because now your eyes are trained to identify these structures, you can even do that. But I will be leaning purely against the demand and supply zone indicator in these sessions. So my step number 3 was to identify a zone, and you can see from the current candle, I can see that below that we have this drop based rally structure which the indicator is identifying for us. So let's mark this drop based rally. So our step number 3, which was identify a zone, is done. We have already identified a zone, which is a drop-based rally structure for us. So is a zone available? The answer is yes, we do have a zone available. Now, once we have identified the zone, does not mean we can blindly trade it. And this is the biggest mistake demand supply traders they do initially. They find any demand area, blindly start buying, find any supply area, blindly start selling, which is incorrect. To participate at a demand area or a supply area, it first has to qualify based on your trade plan. And for that qualification, we look at certain conditions. So the very first condition we look into is that can this zone be a case of level on top of level? Now, why do we start with level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different zone. And how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be completely inside the intermediate time frame zone, which we call as a coinciding level. So if we have a coinciding level, there is a possibility it might be a case of level on top of level. But if we don't have a coinciding level, it cannot be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with with any intermediate time frame zone? And the answer is yes. Here you can see we have this rally based rally which the indicator is identifying for us. And what I'll do is I'll change the color so that we can differentiate between the two. So the one in pink is my is my rally base rally, and the one in green is my lower time frame drop base rally. So is my lower time frame zone completely inside my intermediate time frame zone? The answer is yes, which means we do have a coinciding level. But do we have multiple levels? As if now your answer will be no, because I can only see that inside of this we only have one zone. But mind it, when we talk about cases of level on top of level, it is not mandatory that the other zones might be quality zones. And by default, the indicator only identifies quality zones on your lower time frame. So what I'll do now is I'll go to my settings and I'll change that I want all demand supply structures, not just quality areas. And as soon as I do that, you can see here also we have a drop based rally structure, which the indicator is marking for us now. So if you look into it, we have exactly what we were talking about. We have an intermediate time frame zone, and the same intermediate time frame zone is getting divided into multiple zones on the lower time frame, which makes it as a case of level on top of level. And by default, we are already looking at the lower zone, we are not looking at the upper zone, so we don't have to make any modification. We are already picking the one which we should use in case of a level on top of level. So yes, it is a case of level on top of level, but modification is not required because we are already using the lower zone. Now, this zone has nothing to do with a gap. It is definitely a drop based rally structure, which we call as a pivot or a non authentic zone. The fact is, you can even look at the chart that this zone was formed as a test of a previous zone, which we call as a non authentic zone. It is a non authentic zone, but we don't have to apply the rules of pivot and non authenticity. And the reason for that is, if you go to the rule book, you will see that I have given you a rule that in case of level on top of level, there is no need to apply the pivot or non-authentic rules, because being a case of level on top of level, by default stacks that extra probability we are looking for, right? So whenever we have a structure of pivot or non-authentic zone, we try to add those positive factors. But since it is a case of level on top of level, we already have that positive factor, which is where we need not apply the rules of pivot and non-authenticity, not an unstable equilibrium structure. So after looking at all the applicable rules, is the zone qualified for us? The answer is yes, because it was not disqualified based on any of these conditions. Now, since we know we have a qualified area, we can move ahead and we can look at the booster scoring for the same zone. So the very first one we'll check is freshness. The zone is definitely fresh. Now, I'll definitely add that if I draw my entry and the stop loss line, you can see that from the entry line, it is already tested twice. But since the zone is fresh, starting from the proximal line, I'll still consider it as a fresh zone, right? Unless and until the proximal line is tested, right? But you definitely had two opportunities where you could have participated. But yes, the zone is still fresh. Therefore, we'll give it a score of 3. Talking about strength, we don't have an explosive move, because if I change my indicator settings to explosive, you will see it will not mark it. Because by default for daily time frames and above, I don't use explosive, I use good, because the bigger the time frame, the higher the weightage. So I'm also okay with a good move. So with a good move, it is getting identified for us, but with explosive move, it is not getting identified for us. So we know that we don't have an explosive move, but we do have a good move, and a good move can get a score of 1. Time at the zone, we only have one candle in the basing, gets a score of 2. Reward to risk ratio, we will be taking it as an assumption. Now, talking about location, so this is where we have a symbol which has been making all-time lows. So if a symbol has been making all-time lows, we know that it can further go down. Plus, we do have supply area, but we don't have demand no matter how far back we go. So now the first thing is, if it is making all-time lows, do I try to be a buyer on this, because it can further go down? So my rule, when do I start buying, is available in the rule book. So if I go to the rule book and I go to all-time low, right? So for symbol is making all-time low, what I need is that for a script which is making all-time low, I don't plan a long trade unless and until we see a weekly demand area. So now, because I know this was making all-time lows, I can plan a long trade, provided I can start seeing that some buying has started coming into the market. So now the question can be, now why are you not waiting for a monthly demand zone? Why are you only waiting for a weekly demand area? Because I'm not trying to be extra conservative, because if I want to wait for a monthly demand area, now think about it. As a monthly demand area, prices can trade in this range. Let's say for the basing, maybe 3 or 4 candles. Then let's say we have one leg out. So in a way, it probably took 5 months for the zone to form. And if I'm waiting for 5 months, I've already probably missed quite a substantial move, right? So I don't want to be very delayed. That is why I don't want to use monthly chart. I don't want to be very quick on jumping. That is the reason I don't even want to use the daily chart, right? I want to be somewhere in between. That is the reason I look at monthly. And you can see on the monthly, yes, we were moving down, but now we have started having our formation of weekly demand areas. You can see we had a formation of very first weekly demand area here. Then we have another weekly demand zone. Then we have another weekly demand zone. Plus some weekly supplies have also started getting violated, which basically tells us maybe some buying has started coming into the market, and that's the positive factor for me to start planning a trade which is on the long side, even though the symbol was making all-time lows, right? So yes, I can see those positive factors, which is why I'm perfectly fine planning a long trade. So now the question is, I don't have a demand area to do my curve analysis. So how do I do my curve analysis? So we have taken such cases many times in the past that when you don't have a demand area or a supply area, we use the most recent pivot high or pivot low as a reference point. So I'll take this supply and I'll take this most recent pivot low as my reference point, and now you can see you're planning your trade low on the curve. So yes, we are planning our trade low on the curve, which is a good location to plan a long trade, gets a score of 1. Talking about the trend, if I go to the weekly time frame, you can see in the weekly time frame I am in a sideways trend, which is perfectly fine, gets a score of 0.5. Move from the zone, we need at least 4 is to 1, which has already happened. In fact, maybe a 5 is to 1 move has already happened, so gets a score of 2. It was a case of level on top of level. It is also coinciding. Now, trap in a way becomes irrelevant. Reason is we already have a score which is a high probability score. So whether it is 0 or 1 doesn't make any difference. It will still remain as high probability. But it will be a score of 1. And the reason for that is if I take a horizontal line wherever the proximal is and then start pushing it up, you can see this area has beautifully acted like, just give me a second, acted like support, acting like support, acting like resistance, acting like support, acting like support, acting like resistance, again acting like support, and we are almost at the same area. So since we have a very clean area of support and resistance, what is going to happen? People who believe in support and resistance, they'll be very happy buying here with their stop losses placed below, and these stop losses will be the sell orders. And similarly, if you have a breakout, then people who also trade breakouts will also start selling by the time we are coming into this area of demand. So we know a lot of selling will come into the market as we reach into this area of demand because of the stop losses, because of the breakout, people who do breakout trading. And what are these people doing? They are making two novice mistakes. Mistake number one, selling after a decline in price, which means selling at a cheap price. And mistake number two, selling in an area where the chart has proven to us that back in history, demand exceeded supply, which could be the only reason for the prices to move up. So yes, we do have that possibility that this zone might work like a trap, for which will again give it a score of 1. So if you look at the overall scoring, we have a score of 9, definitely with the assumption of reward to risk ratio, which makes it as a high quality zone, and 6.5, which makes it as a high probability zone. So high quality, high probability can be traded as a type 1 trade. So yes, after applying the boosters, we got to know that this can be a type 1 opportunity for us. So what do we do next? We now do our position size calculation, because no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So we don't want that, if it starts going against us, we are just holding that position. As a rule based trader, it is very important for us to have risk management as one of the key aspect of our trade plan, and this is where it helps us, so that if trade goes against us, we take that small loss, we are done with the trade. Now, whenever the prices are back, we'll have to re-verify whether it still qualifies based on our trade plan or not. If the answer is yes, we place our order based on the entry type, in this case a type 1 trade. And the last step will be trade management, where 1 is to 1, we make it as a break-even trade. And after that, if we get the opportunity to trail onto it, we'll start trailing onto it. And that is how we plan trades and manage trades in a very mechanical and rule-based way. So that takes care of our today's example. And if these sessions are helping you, I'll highly appreciate if you can hit the thumbs up button, you can like the video. And I would also like to add that if you have some friends or family members, or if you're into some trading groups, you can also share the link to my course content, link to my videos in those groups, so that people can take advantage of this methodology. So let's see what do we have in the chat box now. Can you please analyze Shivalik? So again, pullback trading, during these sessions, I only take the examples which I have to share with you. In fact, even the examples that I'm taking, I don't disclose the name of the symbol. So we are not looking into any specific requests. So I apologize for that, right? Because the idea here is that I don't do the homework for you, right? The idea here is I don't give you ready-made trades. It's all about educating you how to plan your trades in a very mechanical and rule-based way. That is why we will only look into the examples which I've shortlisted for you. Okay, in the lower time frame zone is on the leg out of intermediate zone. We still consider, yes, that's perfectly fine, because if you think about a zone is always made up of 3 components, which is your leg in, your basing, and your leg out. Now, ideally, we would definitely want that a coinciding zone, which is the lower time frame zone, should coincide with the basing of the intermediate, but even if it is on the leg out, I'll say as a little aggressive trader, it is still acceptable. But yes, ideally, if the basing is common, it makes a little bit more sense, because for the leg out, the move has already started, but still acceptable if you're not being very conservative. All right, so which broker platform do you use? Because I use Dhan, which can be connected to TradingView. Is that okay? See, again, I use my TradingView only for the analysis part. As far as placing the orders are concerned, I do it on my broker's platform. And, at the end of the day, it's your call which broker you want to use, but I'm not using any of the broker which are connected. In fact, my broker is connected with TradingView, but I still don't place my orders through TradingView. I place the orders on their system, because that is much more convenient for me. So this is where I'm only doing the analysis, placing order using the broker's platform. Okay, I have been thinking about trading futures with supply and demand strategy and indicator. I have been doing my research. Future trades are not kept overnight. What time frames can I use since most entries? See, again, if you have a challenge that those trades cannot be kept overnight. In fact, with futures, it should not be a problem. And now I don't know what markets you're trading, but let's say if I'm talking about the NSE market, which is the India market, here futures positions can be kept overnight, and that is the only way you can take a short position and keep it overnight, right? In the cash market, we can only take long trades and keep it overnight, and that is why you will see almost all the examples that I share with you are long examples. But anyways, uh, if you are doing futures, or even if you're doing it in cash and you strictly want to do it as intraday trades, then what I'll say is HITs and DITs would be a good option for you. Here also, you need to be a little bit more selective with HIT when you're planning your trades. DIT, not as selective, but yes, these are the two possible options for you if you want to do strictly intraday trades. All right. Let's see. Recently, SEBI report came out in which FNO and heavy losses were recorded by the retail traders. So that is something which everyone knows for a fact, that most of the retail traders, they definitely lose money, and that is one challenge, because if you talk about futures, it's a net zero sum game, because somebody has to lose money for someone to make money, right? But in the cash, what happens is, if the company is growing, you definitely make money on it, right? It's not a net zero game when it comes to stocks, because you can hold those stocks for a number of months, a number of years. If the company starts performing well, yes, you start making money on it. But in the future, since you have expiry, you will have to close that position. You cannot carry it forward. Even if you're carrying it forward, you're basically rolling over, but you are booking that loss, and that loss will definitely be someone's profit. Now, same applies to options as well. So that's the case with both, whether it is options or whether it is the futures you're trading. Or it being more conservative increases your probability for profitable trades as the risk decreases. Is that correct? See, being conservative means I am trying to take best of the best trades, which basically implies that my probability of having a winning trade definitely increases. And if not a winning trade, it might give me the opportunity to make it at least break even. So that is where that being conservative helps you a little bit. That what you will see is that your trades, most of them will go in your favor. If not the target, at least they'll give you the opportunity to make it as a break even trade. So your hit rate will increase a little bit. Plus, what you'll also see is when you're being conservative, your reward to risk ratios could also be really, really higher versus when you're taking trades which are not as conservative, right? So you can also have very beautiful reward to risk ratios, 10 is to 1, 12 is to 1, 20 is to 1, right? You can also have those kind of reward to risk ratios. All right. Would you kindly explain more the last part of higher time frame about all time lows? All right. So what I was saying was that this is a symbol which is making all time lows. Now, just as an example, let's say if I was doing my analysis some time back, the symbol is making all time lows. Now, how do I know whether it will start moving up or it will further go down? That is something nobody knows, right? So we know that if this is a symbol which is making all time lows, that implies it is a weak script, right? So what I want to do is, before I start buying it, I would like to see some positive factors that are supporting me to go ahead and start planning a long trade. And what positive factor I look for? I want to see a weekly demand area, formation of a weekly demand area, because A weekly demand area formation means that yes, there is some buying coming into the market, right? And not on a very small time frame. Weekly is still a substantially big enough time frame. Plus, I can also see some violations of weekly supply zones as well. So supplies have started getting violated, demands have started forming, which basically could imply that we have started having some demand coming into the market, which is where if I want to plan some long trades, maybe I can do that, right? So I hope that helps. Would you kindly explain? Okay, so I've already answered that. Uh, Many prop firms have their fund challenges in forex, and they provide funds for profit at a split of 90-10. Have you ever used that? No, I've never tried that, but yes, if you wish to use it, I mean, you wish to try it, you can do that. And I've also heard stories where what these prop firms they basically do is because they know that 90% of traders they lose money, right? So what is going to happen is if on your terminal you are placing a buy order at the back end, instead of buy they'll be placing a sell order because they know that majority of the people will be losing money. So in a way you are losing money, but they are placing the opposite orders, which makes them much more money versus if they were placing exactly what the order the that person has punched in, right? So I also heard stories like this. Now I don't know how true it is, but yes, I've heard those kind of stories as well. Okay, so in the rule book it is given for all time highs the trend is always considered as uptrend downtrend, but today okay, see, it is when the script is making all-time highs or all-time lows. And let me go back to the rule book and help you understand that. So can you see when a script is making all-time highs all-time lows, it is saying that you in all-time lows, for a script making all-time lows, no long trade unless and until we have a weekly demand area. So I'm planning a long trade, right? If I was planning a short trade and I didn't have any weekly demand area, that is where this would have applied, right? Because even if it is showing me sideways or even if it is showing me uptrend, because I'm planning a short trade, since I don't have a weekly demand area on the chart as of now, that is the time these conditions are applicable, right? Currently they are not applicable because I've already seen a weekly demand area which is telling me yes, I can take a long trade now. And since I can take a long trade, I can take the trend from what the chart is showing me. I can also take the location from what the chart is showing me, right? So it is about when a symbol is making all-time lows and I don't have this condition, then these conditions will be applicable, right? So I hope that helps. All right. Is it okay if I first mark the intermediate time frame zone and then inside it mark the lower time frame zone? See, again, let me put it this way. Even when you would have, let's take this so we have some empty space. So even when you would have gone through the theory part, right? If you have already gone through the theory part, you will see that in the theory part I explained you this is how the strategy has to apply. Step 1 is we start with the higher time frame. Step 2 is we go to the intermediate time frame. Step 3 is the lower time frame. But when you see me doing it during these practical sessions, first I am going to the lower time frame, then I'm going to the uh, higher time frame, HTF, and then I'm going to the intermediate time frame, right? So now, just to make it very easy to understand, when as an analogy, when I'm dressing up, whether I wear the shirt first or whether I wear the trouser first doesn't make any difference, right? So similarly, whether you are using the higher time frame first or the lower time frame first or the intermediate time frame first doesn't make any difference. But this is a much more, I'll say, time efficient way of doing it. Why it is time efficient? Because think about it, you start with a higher time frame, you do your curve analysis, let's say it takes you 5 minutes. You go to the intermediate time frame, you do your trend analysis, let's say it takes you another 5 minutes. Then you go to the lower time frame, you spend another 5 minutes, and what you realize is that on the lower time frame you don't have a quality area to plan your trade on. So if you don't have a quality area, you've just wasted 15 minutes to come to a conclusion that I don't have anything which is tradable. Now if I start with the lower time frame as my step number 1, after spending 5 minutes, I get to know that, okay, I don't have a quality area, so I don't have to do my curve analysis, I don't have to do my trend analysis. I've saved myself about 10 minutes. Now, if I find a quality area and then I go to the higher time frame and I see that I am at the best location, so I don't even have to do my trend analysis now. So this is just a more efficient way of doing it, a faster way of doing it, but doesn't matter whether you want to start with the higher time frame or the lower time frame or even the intermediate, because your trade plan might be that I will only be trading coinciding levels. So since I will only be trading coinciding levels, I want to start with the intermediate time frame. First identify where is the intermediate time frame zone, and then I want to check whether I have a zone on the lower time frame that is coinciding. Yes, it makes sense because that is what your trade plan is, right? So wherever is more time efficient for your trade plan, you can go that way, as long as you are not changing the purpose of the time frame. You're using that time frame for that designated purpose. You can go any which ways you wish to. Nothing wrong with that. All right. All right. Let's see what we have next. What according to you should be minimum trading amount if someone wants to start after mastering demand supply? See, again, it depends from person to person. Now, the reason is, if you're doing it, let's say, not as your primary source of income, you're doing it as a secondary source of income, a smaller capital might do for you. If you want to do it as your primary source of income, yes, you might require a bigger capital. So it all depends upon your needs. It also depends what kind of trades you're doing, whether you're doing intraday trades, whether you're doing, let's say, investing, because for investing, you'll have to hold those positions for longer period of time. You will require definitely more capital for intraday trades. A lot of capital might not be required. Plus, you also get leverage for intraday trades, which you don't get when you are doing it as investments. So again, a lot of factors which you will have to look into, and that will help you decide what kind of capital you're comfortable with. All right. So, do you have a fixed reward to risk ratio? Yes, I do look for at least 2:1, but I'm not looking at 2:1 very strictly. Why? Because, like I have said many times, that I'm a very conservative trader. So, but what do I mean by very strictly? Let's say even if I have 1.5, 1.6, 1.7, I'm still okay with it, right? But if I see a very bad reward to risk ratio, just to start with, let's say 1:1, probably I'll not be getting into that trade. But if I'm somewhere close to 2:1 as my target one to start planning my trade, I'll definitely do that. And that is how it is. But again, just because I'm being very conservative with my trades, but at least I still look for something which is close to 2:1. It's not that I get about, let's say, 1.8:1, and for 1.8:1, I'll skip the trade. That is something I'll not do. All right. So that basically answers all the questions that I had in the chat box today. And that also brings us to the end of today's session. Thank you so much for joining in. I will be seeing you now next weekend. Till then, trade safe. Enjoy your Sunday. Take care. Bye bye.